Good morning, everyone. If you can hear me, I'd appreciate it in the chat line if a couple of you could say it's good. Thank you, thank you, thank you. Okay. We'll mostly be working problems today from the end of chapter or the supplementary problems that are posted on Learn. The meeting is being recorded and I started that about a minute ago, so we're all good there. Just a reminder, you have your first quiz at 1 p.m. today. You will have access to the quiz for 15 minutes, but that'll be between 1 and 1:15. The quiz itself is set for 25 minutes. So you just have to access it within that 15-minute window, and then you're good. Your time starts when you connect into the quiz, just so you're aware of that. You're probably aware of this sort of stuff anyway, but I just want to reflect on it. The review for the quiz will not be immediate. I will let you know by email as to when you can review the quiz. So it'll take place after. Due to exam accommodations, there's a few people who who won't be writing it exactly at that time. So I'd prefer to do the review or show the a review of the questions with your answers, with the correct answers if they differ, a little bit later. So that might not even be until tomorrow, but I'll set it up and send out an email to that effect, just so you're aware of it. Let me just see here. I'll mention it again later, but you should also now begin some of your reading for chapter 3. We will be going into that in all likelihood for next week. So you should once again prepare for that, please. And I think we'll start out today with problem. Let me just find the one I want to do here, please. Let's start out here today with problem 2B, which would be a supplementary problem. So I'm going to bring up my document camera here and share it with you. Okay, you should be able to see that now on your screen. Again, I'll look to the chat line to see if that's the case, if you're seeing it or not, or maybe I'll word it differently. If you're not seeing my grid paper on your screen, please let me know. Okay. So problem 2B is a supplementary problem, and it's a bit of a repetitive problem, but I think it's worth doing to start with. So problem 2B, that is a supplementary problem. And it indicates that if the nominal interest rate is 12% and interest is compounded semi-annually, what is the effective interest rate? Now, as we closed out the last lecture, we had been working with the sub-period interest rate and then took a look at the effective interest rate. So we're going to run a few of them on this question, A through E, using a slightly different variable each time we do it. So in the first case, it'll be A, and the prime formula we use for the effective interest rate is IE, or I subscript E, is equal to one plus R over M to the power of M minus 1. So that would be equal to 1 plus R is our nominal interest rate, so that's 12% or 0.12 here. And it's compounded semi-annually, so M would be 2 to the power of 2 minus 1. And when you do that arithmetic, you should end up with an answer of 12.360%. That's an annual rate. It's an effective rate, and we're calculating it on that basis. Part B of that question, similar to the first, except it's going to be compounded monthly instead of semi-annually. Now, once again, the operative word as to when you have a nominal interest rate, as in the question, it is normally either stated as a nominal interest rate, or the operative word compound is used. Compounding annually, semi-annual, quarterly, weekly, monthly, daily, could be hourly, or even down to the minutes and seconds if you're so inclined. So the operative word that you look for when you see an interest rate, is it or is it not compounded? If it's compounded, it is a nominal interest rate. And we, with one exception, which you're about to see here on the next question, and that'll be the only time we use nominal interest rate. Otherwise, we will have to calculate either a sub-period interest rate or an effective interest rate to proceed with the work. So in the second case here, once again, the formula is IE is equal to 1 plus R over M, power of M, minus 1. Again, keep in mind that when you're doing questions for me, each question stands alone. So the fact that you wrote this up here normally would not mean you do not have to write it here. The question stands alone. So do not rely on any of your formulas that you've stated elsewhere in a question. Each segment of the question stands alone. So in this case here, we'd have 1 plus, again, the nominal interest rate has not changed, it's 12%, but this one here is compounded monthly. That's what we were given. And if we're compounded monthly, there'd be 12 such periods in the year. B to the power of 12 minus 1. And if you do that, you'll end up with a percentage here of 12.683%. Again, that would be an annual event, an annual interest rate. So we'll take a look at yet the next one. C, again, the formula, I subscript E, the effective interest rate, is equal to 1 plus R over M to the power of M minus 1, equal to 1 plus 0.12, the nominal interest rate, and must work this, of course, as a decimal. And for C, we're doing it daily. So there are 365 days in the year. Do not get hung up on leap years and things of that nature. Just call it 365 every time you have to use it. 365 to the power minus 1. Again, if you work that, you should get 12.747. So your actual interest rate is increasing, albeit slowly, as the number of compounding periods become more frequent. So I want to do two more of these. D in the question, once again, the prime formula we use, I subscript E is equal to 1 plus R over M, power of M minus 1. Not too frequently, but on occasion, some people make the error in using this formula of forgetting to do the minus 1. So just keep that in mind. You don't want to drop it in the prime formula, and you certainly don't want to drop it in your calculations as you proceed through this. Secondly, always be sure that you carry a number of significant digits, if you will, a number of decimal places might be a better way to put that. Whether you're working with a percent, the interest as a percent or as a decimal. So you want to make sure you do that. If you truncate here and say, well, I'll just call it 13%, or I'll just call it 12%, or 12.5%, you're going to end up in difficulties coming to the correct answer. Always carry significant figures, a number of digits in your interest rate when that is to be used later in a question, because you're basically ignoring the balance, which can have an effect, which often does have an effect on the subsequent work to be done. So keep that in mind, please. So once again, here we'll have our equal signs. It's 1 plus 0.12. Now for D in this question, it's hourly. So the question is, how many hours are there in a year? Well, you could write that out. It would be, of course, 365 multiplied by 24. And if you do that, it becomes 8,760 hours in the day, which is your compounding period, to the power of 8,760. And when you do that arithmetic, you end up here with 12.750%.
Hey, Wayne.
Yeah.
For those smaller calculations, do you require us to show that, or does it matter?
Tell me a little more of the smaller calculations.
Like hours in a year.
No, if you, I can handle it either way. If you just happen to know in your head how many hours there are in a year, or you can cram it into there, 24 times 365, or you can do it on the sideline. Or if you know the number from one means or another, then I'm good with that for this type of work. You okay there?
Yeah, thanks.
You're welcome. So you can see here, the interest rate is still increasing, but lesser every time. So we're going to do one more of these. We'll call it E. So equal to 1 plus R over M, power of M minus 1. And that is equal to 1 plus 0.12 over. Now for E, it's minutes. So how many minutes are there in a year? Well, if there's this many hours, 8,760, then there'd be 8,760 multiplied by the number of minutes in an hour. So you'd be multiplying it by 60. And if you did that, you should end up here with sorry, my mistake there, 525,600 minutes in a year. And that will be equal to, when you work it out, interestingly enough, at least with only carrying 3 decimal places, 12%, I'll try that again, 12.750%. So it's kind of stabilized once we're down to the number of minutes, if compounding is minutes. Now you could do that again, we won't. You could do it for the number of seconds, and you could do it down to the microsecond, I guess, if you wanted to. This number will pretty well stabilize now at 12.750. So that gives you some insight into the calculation of an effective interest rate when the compounding periods are getting more and more and more frequent, but they do tend to stabilize. So I just wanted to do this question so you gain that impression. The next question in the same reference I'm going to do is 2C. And there's a reason for doing these back to back. These are both supplementary questions. I could have written that in there just so that we keep track of it. Now 2C allows us to use a slightly different formula to come to the same answer when compounding is continuous, because that's what we're effectively achieving here. It's becoming more and more frequent, from semi-annual to monthly to daily to hourly and to minutes. And we could go on if you like. But there's a slightly different formula now that we can use if we do that, and it's in the textbook as well. And it is the effective interest rate in this case for question 2C as in Carl or Carol. If the nominal interest rate is 12% and interest is compounded continuously or continuously compounded. There's that word again, compounded, but in this case, continuously. So if it's compounded continuously, and although the ordinary application of that doesn't normally apply in small business, large companies do look at this. They're investing their money and they are returning on their money continuously. In other words, second after second after second, kind of high financing, if you will. Interest is being calculated, added to the previous number, recalculated, added to the previous number. So it's just happened, if you will, continuously. So when you see that word continuously compounded, the formula you should use is i.e. the effective interest rate is equal to e to the power of r minus 1. And that's all there is to it. Except r, as we've noted before, is the nominal interest rate. So that's the only time we're going to actually be doing a calculation of this nature using the nominal interest rate. So if you know the nominal interest rate, and in this case, E is a constant. E is the Euler constant, and you should learn how to find that on your calculator, if you will. So if this is the case here, we could say then that E to the power of R, and R is the nominal interest rate, minus 1. And if you do that, for this case, you're going to end up with 12.750%. Now you can memorize the Euler constant if you're inclined to want to do that. Not recommended. Or learn to extract it from your calculator. Most basic algebraic calculators will have that value in there. If you're using the Casio here, and you wanted to determine what is e to the power of 12, I believe you would press alpha. You would then, and that sets up the red column, and you go here to, there's the e right here. So you push that. You push up for the exponential. The nominal interest rate is 0.12 equals, and then you have to now minus 1. So answer minus 1 equals 12.7496. So 12.750 is what the answer is. So you should learn to do that. Now, on occasion, just so you're aware of this, because it is the sort of question I've asked before, is that you're given the effective interest rate and you now have to calculate the nominal interest rate. So I've reversed it. So be aware that it can go either way. Yeah, you're right. Thank you. I picked this up here. Forgot to write it down here. Thank you for pointing that out to me. So again, I made the mistake I asked you not to make. Don't forget it. So don't forget to carry that through in your calculations. I do apologize for that. A quick and easy fix. Okay, I think we're good there. So once again, I'll repeat that. If the question is saying you're using compounded continuous or continuously compounded interest, this is the formula here you should be using. And by putting that in here, it's a pretty straightforward and very, very quick calculation rather than doing it up here. If it were saying compounded every 10th or 100th of a second, if that proved to be the case, you get a lot of larger numbers and there's no need to go directly to this formula here to take care of it. Okay on that? Okay, I just want to back check on my chat channel here to see if I've covered everything. Yeah. Thanks to the both of you there who sent that note in about the -1. I do value that when it comes back. Okay. Let's turn our attention to problem 2.8 in the back of the book, or excuse me, the back of the chapter. Give you a second to read it, 2.8. These address the part of the chapter 2 that deals with cash flow diagrams. And as I indicated to you, many of the questions you get will ask for a cash flow diagram. I sometimes abbreviate that CFD in my notes anyway, but if it's in a question, I will spell it out fully. So most often I will say you require a cash flow diagram. Now, if I don't ask for a cash flow diagram, there'll be no marks awarded for it, even if you give me one, and you may prefer in your work to still do a cash flow diagram, because it is kind of a handy way to extract out the relevant information from a question, which otherwise is just sort of setting up the numbers. It's the numbers we deal with. So you want to keep that in mind. Now, for a cash flow diagram in this context, this is for question 2.8. Excuse me. The cash flow diagram essentially has two axes, an x-axis and a y-axis. But the y is kind of fuzzy as an axis in this exercise. The x-axis is always your timeline. So for this particular question here, I'm going to draw a timeline, and in the question that we're asked about, it says Margaret is considering an investment that will cost her $500 today. It then pays her $100 at the end of each month for 12 months and cost her another $300 1 year from today. So that's her sort of investment. Pay a little now, pay a little more than a half now, get something in return, and then pay a little bit later at the end of the year in this case. Illustrate these cash flows in two cash flow diagrams. The first should show each cash flow element separately, and the second should show only the net cash flows in each period. So let's show that now. Here's the first one, and I'm just going to lay this out here. I'll do it fairly neat, I hope. But I'm going to use a straight edge. I do recommend a straight edge, although many people just do it freehand, and it seems to work for the most part. But we're going to say 1 year, 2 years. So there's our timeline, and we usually put that in here. Now we've basically, in looking at this question, we're concluding that the money flow is happening on a monthly basis. So I'm going to set this up as months. And we know here at the beginning, I'll put this in here, this is time 0, 1, 2, 3. So there's our 12 months. Now, often you don't need all of those numbers. I'm kind of drawing this out so you get a sense of what is the cash flow diagram. So the first thing that we take from the question is, and essentially what we're doing here is extracting the money matters and putting them into this cash flow diagram. That's what it is. It's a flow of the cash. The cash, how is it flowing? And all disbursements, which we defined earlier, are downward. All receipts, and they may have different words in a question, but money that comes back into a person go upwards. So in this case, we could say here, and it doesn't have to be terribly to scale, but some level of relativity is useful. So I'm just going to throw that in there. And this would be $500. That is what Margaret, is that her name? Yes, Margaret for 2.8 ended up doing here. She made an investment, and in return, she's getting back $100 each month. So 100 here. This is a bit tedious. I'll show you afterwards how we can shorten that up a little bit. So there's her return. And what word did they use in here? It will pay her. So this is money coming back into her. Once again, in a cash flow diagram, any money that is leaving Margaret, it could be you, could be your company, but any money that is going out is a downward arrow. Any money that is coming back in, a saving, a return on an investment, some sort of salvage or scrap value that comes back into the project would be returning to you. Returning money is upwards, money that is going out from you. So look at it from your own perspective or that of your company. And the question is, because this is where many people go wrong. They end up putting these upside down. It's important. Disbursements are down. Receipts as one word, it can be represented in other words, are up. Now, there's one other item in there that we haven't put yet because we have to look back at the question. She still cost her another 300. So she's going to have to come here. So if that's 200, I'm going to go to here. And that will be 300. Each of these, and I'm going to do this quickly here, 100, 100. A little tedious, a little monotonous, but I'll show you here in a minute how we get around that. So there's what we have, and that seems to account for all the money that Margaret is spending or putting out. And that means putting it into a bank as well. Keep that in mind. You sometimes think of it that, you know, I just put $1,000 in the bank, so it's still my money. Well, not really. You've given it to the bank to use. You've spent it out. But in return, the bank will give you back that money with interest later down on the timeline. So even though you're investing in a bank or a credit union or some sort of Canada savings bond or some sort of guaranteed investment certificate, even though it could be still deemed to be your money because you're putting it into your bank account, it is still money that's leaving you. You're putting money into that investment vehicle, to use a generic term here. So try to keep that in mind because there'll be a number of questions that come up where you'll have to ponder that. Now, this would be the correct answer for the first cash flow diagram that she asked for. Now, it doesn't come up here, but I'm going to show this to you here as an add-on, if you will. I'm just looking. Maybe I'll do it with this. I'll do it with this blue pencil here. This is an annuity. We have yet to kind of define what is an annuity. But annuity is a same payment being made on a very periodic basis. In other words, every month, $100 is being paid. That it constitutes an annuity. And when you have an annuity, you can draw it in this way. As shown in blue. And you would just put up here $100. So all of those up arrows and all of these 100s can be replaced by the blue. So it starts out here and it goes from the time 0 to the end of the first year, or first month in this case is what I should say. Could be a year. Usually they're years and months, but they can be hours. They could be in 2-year periods, if you will. But again, once it fits the definition of an annuity, you can show it this way. This is usually, I won't say always, but I typically draw it as a 45-degree line up to the end of the first year, and then paralleling the timeline here, and then writing 100 along here. And that would be $100. I would at $100 per month, just so I know the period of time I'm dealing with. So that would take care of that and make the work go a little faster, if you will, when you're preparing your cash flow diagram. Up here, I wanted to write this down before I forget. It's end of chapter question 2.8, just so we know. And you're looking back at your notes, and I know as well. So that's what we have here. Going back to the red, though, we could, because the second part of the question says, and show only the net cash flow, so we can start combining things. Well, there's not much we can combine on the individual cash outflow or a cash inflow. But over here, we have a cash inflow with a cash outflow. So what we could do in that case is, and I'm going to do this quickly here for the second one. And I'm going to go back to the individual cash flow elements here. We're going to have 500 here. But we're combining things here. Well, there's nothing we can combine with this one. So it's going to be 100, another 100. This should be for the first month, the second month, the third month, the fourth, the fifth. Third, fourth, but when we get to the 12th month, we realize there's still $100 going out, but $100 coming back in, but 300 going out. So the net effect of this would be 200. So we can combine them when they occur, when amounts occur at the same point in time. Now, if we were doing this, treating this as an annuity though, all we'd have to do here to make it a little easier when we get to annuities, which won't be far in the future, we would draw the line here, but we would have to terminate it here. We can't go to here because the regular payments, the constant payments of $100 cease here. We've combined these and we have one net effect. So you can still show this as $100 per month here to kind of draw it much quicker. And that's an annuity. Now we're going to have other features that we put on a cash flow diagram as well, and that will be things like an arithmetic gradient series and a geometric gradient series. They're shown differently with different symbology or line work. We won't do that here. We'll handle it as we get into chapter 3 and they start to occur as a part of the studies that we do. But just keep that in mind. There's 4 cash flows: a single payment, an annuity, an arithmetic gradient, and a geometric gradient. Those will be the 4 that we typically deal with. And there's a way to represent each of those so that the line work alone tells you what cash flow type you have. Yes, the cash flow value must be equal each time. So if this were 150, it's not, but if it were, you couldn't do it. The cash flow, the period has to be the same. The interval, sometimes people call it, the interval or the period has to be the same. This is monthly. Don't worry over the fact that some months have 31 days and February has 28. A month is a month is a month. Just go with that. If this were 150, you couldn't do that. If this were 200, you couldn't do it. If this was 500, the annuity must always be the same. Every month, could be every year, could be every hour, and the same amount is necessary to constitute an annuity. Okay, so again, that'll become very straightforward for you to understand and work with as we do more and more questions, because as we get into this, just about, not all, but just about every question we do will require a cash flow diagram. But showing the annuity this way and showing the arithmetic gradient and geometrical gradient in the ways that we will soon talk about will be much quicker than putting in each individual amount. Also in the computations are set up so that we can proceed that way as well. Working with annuities, arithmetic gradients, geometric gradients, and single amounts. But we're not there yet. So that explains this one here for 2.8. So the next one I want to do here is 2.13. Now this one's not particularly hard, and there's not a lot of arithmetic involved in it. Just give me a minute here to get some of my paperwork set up here. I need a slightly larger desk, maybe, I don't know. I want to just find something in the book here first before we we're eventually going to start talking about market values and book values. Book value is very important. Scrap value, salvage value. These are 4 terms. They're well defined in the textbook as well as in my my asymmetric lectures. Not asymmetric. Let me just think here for a minute, please. In my online lectures, anyway, I can't get the word out of my head here. I'll deal with it in a minute. We need to know a little bit about what is a market value and what is a book value. Book value is very important to understand that, and we're going to get into some of our computations related to that very, very shortly here. But I'll just give you a minute here, and this is on page 30 of the textbook. If you'd like to take a look at that, you can see what defines a market value. It's usually defined as the actual value of an asset that can be sold for in an open market. That's the market value. We often don't know the market value until it's sold. That's the difficulty. But what we can calculate is the book value. The book value is what we believe it could be sold for. And we need that book value for a number of situations. One is for one of the reasons for the book value is for when we are trying to calculate a return on our investment when something is sold off. It's like it's a value of the book. So you may have a piece of equipment that is, we'll say, its life expectancy is 10 years, but you decide you want to sell it at the end of the 5th year. So what is its book value at the end of the 5th year? Once you sell it, you now know its market value. But up to that point, you don't know the market value. So you can calculate, and we will do that, the book value of any asset if we have the right information to begin with. And we'll do a number of those questions here today. Okay. The book value is the depreciated value of an asset for accounting purposes as calculated with a depreciation model. There's that word model. We talked about that in chapter 1. The model comes in the form of a number of tested, proven formulas that we use. And there's a number, maybe I think in the textbook they mentioned 6 different models for calculating the depreciation of an asset. We will only study 2 of them. One is the straight line method. The other is the declining balance method. So for this question here, I have to find it here in the book. Chapter 2. 213. Says here, a company selling a particular type of web indexing software is approached by two larger firms for a possible buyout. I think that's what happened here for Skip the Dishes. That was developed here in Winnipeg by someone, and then someone bought them out with a sort of cash amount. The current value of the company based on the financial statements is 4.5 million. Two bids are for 4 million and 7 million respectively. Both bids are bona fide, meaning they're quality bids. They're not just someone kind of putting out a feeler. They're bids that are on the table. All you have to do is pick one or the other. So the question is, what is the market value of the company? Secondly, what is the book value of the company? Well, the book value in this case, I guess I can write it down here if you like. And book value is often written BV, book value. The book value will be 4.5 million. That's stated pretty much in the question. The current value of the company based on recent financial statements is 4.5. So that's the book value. That's what you believe you can get for it. But until you actually sell it, it's not a market value. However, you would choose, if you choose one of the two offers, you now know the market value. Presumably, if you have those two on the table, the market value in this case would be 7 million. Now, of course, you could have accepted the 4 million and it would be the market value then. Pretty dumb if you do that, but I guess we have the right to be dumb sometimes. So you would probably choose the 7 million, but both of these will be a market value if actually the company, the software is actually sold for that amount, one of those amounts of money. If you sell it for 4 million, that's the market value. If you sell it for 7 million, that's the market value. So I'll ask that you kind of keep that in mind. We don't use a lot of work with market value, but book value is very important because all assets you have, whether it's a front end loader, whether it is a skid, steer skid, whether it is some sort of earth moving equipment, some sort of drill mechanism, those are all assets. And it doesn't matter what they're called when you're doing your calculations, but we will now do a few questions within which we will calculate the book value using one and or the other method that I've spoken about. So let's take a look at question 217. It says an asset costs $4,000 and has a scrap value of $3,000 after 7 years. There's a slight difference between the scrap value and the salvage value, but mathematically it won't matter whether you call it a scrap value or a salvage value. Whatever the question uses, go with it. It's not a different formula. So it is, if you will, I just want to go back to the question here, sorry. An asset costs $14,000, has a scrap value of $3,000 after 7 years. Calculate its book value using straight line depreciation. So let's take a look at that then. Now, I want you to be somewhat aware of these formulas, by the way, will all part of the formula sheets that I've provided in Learn. They're in the back of the textbook. Sometimes I put in Learn a few extra formulas. You should be aware of that. I just feel the list that the author gave us may come up a little short in a couple of places. So I've added a few extra formulas in my version online in Learn. But For question, get rid of this one here. This is question 217, so EOC 2.17, part A. Says here, what is the book value? Is that what we're asking for here? Let me catch up with it. Calculate the book value using the straight line depreciation. Make sure when you're doing these questions or in real life, you realize what method you're using. Different formulas involved. The same formula is not applicable to both methods. You need to appreciate that so that when you're doing a question, and I've had students do that where I've said that you should be that the declining balance rate is something, and then they turn around and do it as a straight line problem, and of course nothing is correct from that point on. So make sure it's a good idea. I don't know if you're kind of like me or not that way, but I tend to be a bit of an underliner and a highlighter. So when you have that, you see that in the question, it's probably a good thing to highlight. Straight line method, declining balance method. Sometimes the method is not mentioned, but from the data you're given, it becomes pretty obvious which method it is. So the book value here for straight line, SL, that's a subscript, for the nth year is equal to purchase price minus what the year is we're looking at, purchase price minus salvage value, which in this case we will interpret as the scrap value. They're both S's, no big deal, over the life expectancy. Now I want you to be careful here, because in this case, I just want to look at the question here, after 1 year, after 4 years, and after 7 years. In some cases, this N is notation. You do not factor it into your arithmetic. In other cases, it's an arithmetic part of the formula, and you do factor it in. It's a little awkward, I believe, but this is how the book presents it, and I'm not going to turn it upside down. I think if I were writing this, I would have made that in there a subscript, because it is not part of the formula. So we're doing this for year 1. So the book value, there's your prime formula. So I'm going to write that down here. Book, whoops, excuse me, my pen just flew apart. Book value using the single line, straight line method for year 1 is equal to the purchase price. Purchase price, the asset cost $14,000, so that's the purchase price. Minus N, which is 1, you're doing it for the first year, onto purchase price, 14,000, minus the salvage value. They called it a scrap value, make no difference in that. 3,000. Mathematically, it doesn't matter. Divided by N, and it said it has that scrap value after 7 years. So that's the life expectancy of this piece of equipment, this asset. And when you do the arithmetic on that, you should end up with $428.57. So that would be the book value after 1 year. Now, it also goes on to say, what would it be after 4 years? So we're going to use that for part B. And once again, keeping with what I expect to see, the prime formula, book value, straight line method, N equal to purchase price minus N onto purchase price minus the salvage value or scrap value by the life expectancy. Now, in this case, N is 4. So we're going to notate it here. The book value, straight line methods, 4 going to be equal to purchase price, 14,000, minus 4 for that N, onto 14,000, minus 3,000 over the life of the asset, 7 years. And if you do that arithmetic, you should end up with $7,714.29. So that would be the book value using the straight line method for year 4. What I've seen more than too many, I'll try that differently. What I've seen on an occasional basis is now someone will say, and I'll do it here, I'm going to do it in pencil because it's not true. They'll then say, well, the book value, straight line, is going to be equal to $7,714.29 divided by 4 equal to something. That is wrong. This is notation on this side of the formula. Turned out to be part of the arithmetic. So be aware of that when you're handling these formulas that are in the textbook. So just so there's no confusion here, and I don't want to leave something that you might get mixed up with here, I'm going to just erase that. That was just to make the point. Okay. We'll do it one more time for C. And C is after 7 years. Well, the book value, straight line method, for the nth year, whatever that is, in our case it'll be 7, will be equal to the purchase value minus the end value, same as this, onto purchase price minus the salvage value, or could be the scrap value, divided by the life of that asset. So in our case here, I'm going to put book value, straight line method, year 7, going to be equal to the purchase price minus N, which is 7, onto 14,000 minus 3,000 divided by the life expectancy, which is also 7. So if you do this arithmetic, you would end up with $3,000. These two cancel out. 14 minus 14 plus 3,000 goes to 3,000. Okay. So one of the, to repeat, I guess is the way I'll put it, one of the things you should keep in mind here is that sometimes N is notation, sometimes N is a part of the arithmetic. So you have to be aware of the formulas that have to be aware that in the formulas you're using, whether or not it's notation or calculation. Keep that in mind, please. So that takes care of that question there of 217. So let's look at 218 next. Now I think in my work, in my lectures that were published online, I may have said just work part B of this question. But for the practice, we'll do parts A, B, and C here. So this will be EOC 218. We'll do all three parts, even though I think in my lectures that were online, I only said to do B. Of course, you should be doing as many as you physically can do of these questions during your studies, not just the ones that I point out. So this one is 218 is an asset cost 14,000. Okay, that sounds familiar. The depreciation rate is 20%. Calculate the book value using the declining balance method. So there's a different formula here for that. The declining balance method, when calculating the book value, DB for declining balance for the nth year, whether that's year 1 or year 2 or year 3 or whatever, is going to be equal to the purchase price onto 1 minus D, which is your depreciation rate, to N. So depending upon which year you're looking at. So in the first case, they said for 1 year. So that's going to be pretty straightforward. Book value, declining balance for year 1. Purchase price again was 14,000 onto 1 minus the depreciation rate. Now in this, we were told the depreciation rate is 20%. So 0.2 to the power of N, 1. So the book value, declining balance for year 1, will be equal to $11,200. Now you can quickly compare that to the one we just worked, because the other one, it was worth $12,428 for the first year. So that you don't get the same book value if you're using different methods of depreciation. For part B of this, again, the formula, book value, DB, N equal to P, 1 minus D, being P is the purchase price, D is the depreciation rate, to N. Well, we're being asked in the second part of this for 4 years. So the book value, DB, for the 4th year is equal to the purchase price, 14,000, onto 1 minus the depreciation rate, 0.2, to the power of N, which is 4. You do that arithmetic, and you should get $5,734.40. Do not, because this is notation, divide this number by 4 to get what you believe would be the right answer. Notation, arithmetic in this case. There are formulas as well where notation can even be on the right-hand side of these equations, not this one, but on others. So you need to pay attention to that as we do it. I believe we'll encounter that as we continue our work here. Let's do C, just for the sake of it. Book value, DB, N equal to P, 1 minus D to the power of N. So book value, DB. And for this one here, for C is 7 years, equal to 14,000. 1 minus 0.20. The rate of depreciation is given in the question, does not change for this question. N though is 7. So book value, DB, for year at the end of year 7 will be equal to $2,936.01. Okay. Again, do not divide by 7. This is notation. It's telling you at the end of the 7th year. Over here, it's a part of the arithmetic. So that'll give you some insight into that in terms of straight line and declining balance methods. I generally don't get hung up if you don't carry the dBs through all of this. It's apparent from the formula which method you're using, but to be strictly correct, if you're doing this for a client, you might do that. But for your exam purposes, etc., don't get too strung out on that. If you want to put it down, fine. But I don't look for that and take any mark away because it's not there. It's the formula. I'll know if you're using the correct formula. Couple of pointers each time. Each is a segment. So the prime formula is repeated each time. Don't write it once. Write it for each occasion or each segment of the question. Okay, on that one. Just jumping ahead here. The next one I think I noted in the lectures was to deal with question 243, 2.43. So let's take a look at that one as we continue through these. So VOC 2.43. I might go back to this one here just to show you again any one of these segments, what I would look for. The prime formula, the 1 mark, putting the correct values in, another mark. Damn that thing. My pen keeps breaking on me here. Try it again. And for your final answer. So something like that, I would probably allocate 3 marks for that type of question. Prime formula, correct values put in, and then the final answer. If you put another line in here, because that's how you like to handle your arithmetic work, that's fine. Go ahead and do that, but there's no mark awarded for that. So in this type of question, these are it. Same would apply here, 3 marks, 3 marks. On the other one, same idea. Prime formula, that same formula with the correct values put in. End result, 3 marks. So I just wanted to point that out. I meant to do that when we were doing them and I lost track of it. So we're now looking at question 2.43. Okay. This question reads, a new book, try that again. A new press brake costs York Steel $780,000. It is expected to last 20 years with a $60,000 salvage value. What rate of depreciation using the declining balance method will produce a book value after 20 years that is equal to the salvage value of the press? So in that case, we're being asked to solve for what is the depreciation rate using the declining balance method. So the depreciation rate using the declining balance method, D is what we're looking for, and it is equal to 1 minus the nth root of the salvage value divided by the purchase price. Now I tend to use, rather than roots, exponentials. So I'm just going to rewrite that here. You can do it this way or use the root if you like, but it would be 1 minus S divided by P to the 1 over N. Either way is fine. I have no difficulty with whichever way you prefer. So if we put some values in here, we're still looking for D. It's going to be 1 minus the salvage value after the 20 years will be $60,000. The purchase price was $780,000. Sorry, I'm a little slow there. I'm just looking back at the textbook to get the information from it here. To the power of 1 over N, and N in this case is 20. So if you do that arithmetic, you should end up with 12.04%. Once again, if you were doing this, you'd get 1 for the prime formula, 1 for the prime formula, 1 for that formula with the correct numbers put into it, and then 1 for your bottom result. Okay, on that, so the last one that I had in our online lectures, asynchronous lectures, was to do problem 2.44, which is the next one. So I'd like to take a look at it as well. Keep in mind that if you encounter one of the problems here, whether we've done it and you're still struggling with it, or whether it's another problem you've tried on your own, and I encourage you to do as many of them as possible, and you would like me to do it in the next class, just send me an email saying, would appreciate if you could do question 2.44C, for example. And I'll put it on my list to be done in the next lecture, if that helps you out. As well, you can send me your work by email, and I can take a look at it and perhaps quickly discover where you went wrong and email that back to you. Or alternatively, I may agree to meet you online in my personal WebEx room where we can go over it together to talk our way through it. That's subject, of course, to me having time to do that, because I currently am teaching 3 courses, all of which are online, and I have to pay a lot of attention to each of these 3 courses, not just this one. But I will do my best to get back to you one way or another, if possible. So as another resource, if you will, as we go through this material, please do that. Excuse me. Okay, this one here will be EOC, end of chapter 2.44, part A. I'll do A here. So let's take a look at it. Okay, using straight line depreciation. So right away it's telling us up front the method. And again, if this were an exam question, when I would do exams of these natures, I would highlight that. I don't want to lose track of the fact that those are that's the package of formulas I should be using, the one for straight line depreciation. What is the book value after 4 years for an asset costing $150,000 that has a salvage value of $25,000 after 10 years? Okay, so we're looking again at the depreciation. So it's we're looking for what is the book value. So the book value, straight line, after 4 years. I'm gonna put N in here, the prime formula to begin with. It's equal to P minus N on to P minus S over the life of that asset. So in this particular case, I'm just going to write this again, book value, straight line, and we are looking at what is the book value after 4 years. So it's in the 4th year we're interested in. It's going to be equal to the purchase price. The asset is $150,000 minus N. N is 4, 4th year, onto purchase price, $150,000. Whoops. Put my comma in just a little too early. Minus the salvage value, $25,000, and and that would occur at year 10. So you'd be salvaging it at the end of its life, if you will, or at the end of year 10. So if we do that, again, the book value, straight line, year 4. If you do all of the arithmetic associated with that, you should come up with $100,000. That would be the book value at the end of year 4. Again, I know I'm repeating it and you're getting tired of hearing this from me, I'm sure. Do not now divide this number by 4 and get 25,000. I have seen more than 1 or 2 students do that, and of course, they will get some value. They get a value for this line and value for this line, but for this one, nope. So you'd get 2 out of 3 if you do that. So why throw away the extra mark? Keep focused on that. Notation, or is it part of the calculations? Usually on the left-hand side, it's always notation. On the right-hand side of the equation, it can be notation as well, but usually arithmetic. But again, you'll have to, as we look at those formulas, you'll be able to discern that difference. So part B of this, right here, is using declining balance depreciation with 20%, D equal to 20%. What is the book value after 4 years for the asset costing $150,000? What is the depreciation charge in the 5th year? So we have 2 parts in this. One is what is the book value? So the book value using the declining balance method for the nth year will be equal to the purchase price onto 1 minus D to the power of N. So the book value here, in our case, book value, DB, and in our case, I'm going back to the question here, it's after 4 years, so N is 4 again. Going to be equal to the purchase price. It's $150,000. Onto 1 minus, and the depreciation rate is given in this question, 20%, 0.2 to the power of N. N is 4. So it would be equal to $61,440. Quite a difference between the two, both at the end of 4 years, both dealing with a piece of equipment that costs $150,000. But the difference in the book value, straight lines 100,000, declining balance is 61.44 thousand. So again, there's a notable difference between the methods that are used. Revenue Canada requires, and they stipulate this through a schedule of all sorts of assets, which method should be used. And more often, by far than not, it's the declining balance method. The straight line method can be used. Your company that you work for or the one that you run, you may choose to use that. But for income tax purposes, you'll have to use the declining balance method. So one might say, if I were going to the bank to get a loan and I'm going to use that asset as collateral, I might want to use this method. Because after 4 years, I've had it for 4 years, I can tell the bank, in all honesty, although I'd have to qualify it, that I have an asset that's worth $100,000 at this time. But the bank would probably say, what method did you use? And you'd have to say straight line. Alternatively, you could have told them it's only worth $61.44 thousand using the declining balance method. But normally you pick the number, and there's nothing illegal about it. There's nothing wrong with picking the number that best favors you, providing you're indicating the method you're using. And the bank may be happy with that. So just a pointer or two there, because some of you may eventually, or maybe right away, start up your own company to provide a service to larger companies. Or you simply may work for a larger company and you're working your way up in management and now have to be aware of such calculations as to what is the book value of a particular asset at a particular time. So that's B, and C is here.
Hey, Wayne,
Yeah,
what's the depreciation charge, both in this question, B and A?
well, in B, it's the charge is the amount, whereas the depreciation rate is a percentage. So I'm not sure if I'm answering your question well there, but
Well, is the book value then the depreciation charge?
no, these are values. They're not this and this are their book values at the end of a particular time. In these cases, both 4 years. So that's a that's how much it's worth, if you will. The depreciation charge per year in the first one would be what you would charge at the end of year 1. So it would simply be P minus S divided by N is what it would be.
Okay.
So do try to distinguish between a depreciation rate and a depreciation charge. The charge is an amount of money. And when you're using this, the straight line method, the depreciation charge will be the same every year. It'll be the same for year 1, year 2, year 3, year 4, all the way up to when the asset is sold, if you will, at its salvage value after, say, 10 years. That's not true here. Here, it becomes a function, it's a percentage of its worth the year before. So this is straight line. This is non-linear. This will be a curve in terms of its book value. And those are expounded on in the textbook as to the various diagrams showing you what a straight line depreciation will be. Straight line depreciation amount will be, excuse me, let me just get the numbers here then. The actual amount will be, it looks like 1,600 and some change, just under 1,600. So if you calculate the amount, and there's a formula to do that, I can locate that for you here, I think. If you go back for part straight line, here's where I'm headed, into the textbook. And the depreciation charge, that's noted by big D as in David. And it's the purchase price minus the salvage value divided by N, large N, being the number of years in its life, P minus S over N. But it'll be the same for every year because it's straight line, and you'll see on page 32 where that's defined. So try not to mix up the term depreciation charge, which is an amount, and depreciation rate, which is a percentage, if you will. It's a rate. Those are two different quantities, if you will. I don't know if that helps or not.
Yeah, it helps. And when it says what is the depreciation charge in the 5th year, would you just take the 1 year of the 5th year, or like from the 1st year through the 5th year?
If it was asking for the charge, you would do it for each year because for straight line, it'll be the same amount each year. But for declining balance, that amount will change because it's always a function of what it was worth the previous year. It's like it is, I'm not sure how to, maybe I'll flip this over here a bit.
Can you do an example?
Yeah, possibly. I want to finish that question there, but I want to just sketch this out to you here. If you're doing depreciation here, straight line, this is what the chart would look like. This would be its purchase price here, and this is what it would be worth at salvage. So it's straight line. Depreciation will look something like, it usually depreciates quickly and then less and less and less as time goes on. So it'll look something like this. So the charge would be, say, for a year, if this is a year, the charge would be this amount here for this year. And for over here, maybe I should put it this way, and the amount will be it'll get less and less and less as time goes on. Straight line, it'll be the same amount as we go through it. There are some questions, I don't know which ones right now, that are in the end of chapter where you'll encounter that. Hopefully you can work your way through that. But again, send me your work if you're having trouble with it, and I will take a quick look at it, hopefully pick up what you're doing wrong. Just take a picture with your camera and email it to me. It's all you have to do with your smartphone, and email it to me.
Hey, Wayne.
Mm-hmm.
I think they're just getting at, we didn't complete the questions we were doing.
No, you're quite correct. And that's why I said I'll have to come back to this page. You're absolutely right. And I'm aware of that. I put C down there and then I rubbed it out because in this question, and thanks for pointing that out for everyone to understand, but it says, what is the depreciation charge in the 5th year? Well, the depreciation charge in the 5th year, we need to know what it was worth in the 4th year, the year preceding it. So maybe that's where and I think you're correct, that's where it's coming from, is that we hadn't finished the question yet. So in this case, it brings out an interesting scenario, which I'll serve to point out to you here. But this will be for the second part of it, the depreciation charge, which is D, capital D, as in David, using the declining balance method for whatever year we're talking about, will be equal to the book value, DB, of the previous year, N minus 1, multiplied by D being the depreciation rate. So this is where I was mentioning earlier, sometimes on the right-hand side, N is a notation on this side. So again, after doing it a couple times, it'll probably come a little clearer. But what we're doing here is saying that the depreciation charge, big D, the rate is little d, as in here. D here, big D is a charge, is DB for the 5th year. So we have to calculate what would be the book value. I'm going to write this out this time. Here, DB for year N minus 1. Well, if N is 5, this will be 4 times D. So we just finished calculating this value here, up in here. So we now know from the previous part of this question, what is the book value the year before 5, which is year 4. So again, N minus 1 is notation. So if you're doing year 5, you need to know the book value for year 4. So we'll put the numbers into that. DB for the 5th year will be the book value for there. So it'll be 61,440 multiplied by D, the rate. The rate has not changed, 0.20 or 0.2, whichever way you want to put it, which in turn should be equal to $12,288. So that's your charge here, whereas the rate is 20%. Maybe that does a better job of answering the question that came up prior. And so I know I'm kind of restating these things, but again, notation, in this case, also notation, N minus 1. If you're looking for year 10, you'd want to know what is the book value for year 9. So you'd have to go back to this part to calculate what it would be for year 9, if that were the case. So again, that'll help you get through that, I hope. C is a pretty straightforward one. And in this question here, C is what is the depreciation rate? So we're looking for little d using declining balance for an asset costing $150,000 and having a salvage value of $25,000 after 10 years. So that formula is D is going to be equal to 1 minus salvage value divided by the purchase price to the power of 1 over n. That's calculation. So we're going to have here 1 minus, and from the textbook, the question, we're saying that the salvage value after 10 years is 25,000. Its purchase price was 150,000. And we're looking at that, the 10th root of it, which would be 1/10 up here, 10 years, after 10 years. If you do that arithmetic, you should end up with 16.4% for that one there. Okay, those are all the questions that I'd lined up for today. And I wanted to use the balance of our work here for today to just briefly point out a couple of things regarding chapter 3, because you should now be looking into chapter 3. And we're going to start using tables now instead of doing a lot of the calculations longhand. Both methods work, but when you do them with the formulas that are more complex than using the tables, you introduce the possibility of arithmetical mistakes in your calculations, and it's going to take you longer to do the question, which you don't have in your favor on an exam. So using the formulas, using the tables in place of the formulas is something you should use when the tables are available to you. And by that, I don't mean that the tables are simply in your hand. And you'll see what I mean by that as we work it. But if you take a look in the textbook here as we go into chapter 3, we will start looking at values. And you're going to, at least in the first instance, the things you're going to know to start with is that your question will probably have an interest rate, I, and that can be IS or IE. Cannot be the nominal rate. Must be IS or IE, doesn't matter. Whichever one you choose to work with, the tables will function. So the other thing you're going to know is the number of compounding periods. Periods or intervals, doesn't matter. Over here, this is I is the interest. So I'm going to say that in your question, this may or may not, if it lines up with any question, it's more coincidental than anything. We'll say I is going to be equal to, we'll say it's IS or IE, it won't matter, but we'll say it's 4%. And we'll say N is 17 intervals or periods of compounding. So if I have that information, see if I can do this on the camera here. I'm going to open up the textbook at that time. This is just to get you started using these tables. So I'm going to go here into the back of the book where I have these tables. And I'll go back to the first page. They're compound interest factors for discrete compounding, discrete cash flows, which is what we're using. You could have continuous compounding and continuous cash flows, but we're not working our tables with that information. That's for much more advanced studies, if in fact it comes up there. So what you do, if you know the interest rate and you know the number of compounding periods, you're going to extract a formula. Excuse me, my mistake. You're going to extract a factor. So out of this, we'll look at 4%. So in the top left-hand corner of the tables, maybe I'll draw it out a bit here. In this case, the first one, 0.5%, 1%, 0.1, 0.5%, sorry, I keep saying point, I'm wrong by doing that. I is equal to 1.5%, I is equal to 2%. I is equal to 3%. I is equal to 4%. That's what we wanted. I equal to 4%. So you're going to quickly thumb through these to find I equal whatever value you have. Then you will go down the N column. N is the number of compounding periods or compounding intervals. So we said it would be 17. So I'm going to come down here to 17. And there's a table, and then you go across. And depending upon what you're looking for, which is what chapter 3 is going to expose us to, if we're looking for a compound interest factor, we choose this factor. If it's a present worth factor, these are single payments, one amount only. Over here, though, we have uniform series. An annuity, where am I here? The arithmetical gradient. These are all annuities here, all of these. And they're used in 4 different applications that we will talk about. Over here, it's the arithmetic gradient series, and I mentioned that earlier. You'll be exposed to that now in this chapter. The one that's not in the table that we have to calculate by hand is the geometric gradient factor. So I'm just, as an introduction to this, we'll go through this in greater detail, working a problem come next week on these. But in the meantime, if you're going, well, not if, you should be going through the material in the book. And when they refer to the tables, that's what they're talking about. You know an I value, you know an N value. And depending upon what you're doing, are you looking for a future value from a present value? Knowing I and N, that's the factor we're going to use. And when you go back into the textbook itself, in chapter 3, that is somewhat explained how you can word that. And it's explained somewhat on page 55 and 56 in their very first example, after they get through some of the differences here, some of the related information. But here it is here. If you had a future value here, where am I? You have a future value here. That's what you're looking for. P is your present value, and you're going to multiply it by 1 plus I to the power of N. Fine. However, we could use, by knowing what this is, I plus 1, try that again, 1 plus I to the power of N, we can extract that value out of the tables. Now, that's not a great advantage when you're using a single amount, determining a future or a present value. But as the formulas get a little more complex, that becomes very valuable to know that. So what we would do here then is say the future value would be equal to, just in the above formula, P onto 1 plus I to the power of N, or we would say P multiplied by the factor FPIN. And we would interpret FPIN to mean, explained on the next page, a handy way of thinking of the notation is reading from left to right. What is F if we know P, I, and N? So I'm going to go back to that. What is F if I know P, the present value, I, the interest rate, and N, the number of compounding periods? That value is in the tables. So all you have to do is look that number up, multiply it by P, and you have your answer. If you could do it in reverse as well, which probably comes up on the next page. So I just wanted to give you that little exposure as we conclude our work today, so that when you're working ahead on this, and you very quickly will encounter these factor statements, I tend to call them, after you kind of read through the introduction, talk about the different types of compounding interest factors, dealing with single amounts, or dealing with annuities, or dealing with arithmetic gradient series, and ultimately geometric gradient series. We will start using tables for this when they work. Now, you may say, well, why wouldn't they work if I'm holding them in my hand? Well, maybe if you go through these tables here, and I'll flip quickly to get to where I need to be as I round this off here. 11%. Here's 12%, 13%, 14%, 15%, 20%. So there's no I value for 17 or 18 or 19 or 16%. So if that were the case, you can't use the tables because there's no table corresponding to that interest. Now there's a way around that where we'll use what's called linear interpolation, but in the initial sense, that's one way the tables won't work directly. Similarly, in this table, I'll go ahead further, pick out a couple more here somewhere. I'm coming down here, and let's say the compounding periods was 40. Well, I have no table for 40, where n is equal to 40. So again, the tables would not work. There's a way to solve that problem, and we'll work on it in this chapter. But again, the tables are not directly available to you when I use that term. So you'll need to keep that in mind somewhat. Maybe if I go back here. Yeah, back here where I is equal to 7. Well, we got 5, 10, 15, 20, 25, 30, 35. There's nothing between 35 and 40, nothing between 40 and 45, nothing between 50 and 55. So in this case, the tables would not lend themselves for directly extracting the number. We'll have to use a technique referred to as linear interpolation. And there's a set process to use that we will study in this chapter as well. So again, just trying to give you that insight prior to undertaking the beginning of this chapter. What I will do next week is start reviewing questions where this all applies, if you will. And I'll expound on it, which relates us back to the information that's in the textbook in the asynchronous lectures as well. So that's all I have for today. Guess we have 8 more minutes, but that's something we're not going to do. So I'm pretty well done. Of what I want to do today, I'm just checking
Hey, Wayne,
the chat line. Yeah.
for next week's quiz, is it same time?
All my quizzes will be at 1 o'clock. And we are now finished chapter 2. So I got to go back to my notes here to make sure I cover that. So yes, you will have a chapter 2 quiz 1 week today at 1 o'clock. Now I will send out an email to that. That's normally my pattern, to announce it in class, and then that day or a day or two later, confirm that with an email, just to confirm so you have it in front of you via email. So you should, anyone using exam accommodations, put that in. Don't get too hung up on the length of the time. Just say a half an hour or whatever. I'll make the appropriate adjustments. That's proper all the way around. That's no problem for me to do. So yes, chapter 2 quiz will happen. Now that quiz also, though, will be theory, not arithmetic. Okay, so I'm testing in the quizzes, I'm testing you on theory. That's what you need to understand for chapter 2.
And is it all just from the textbook? Because we don't have access to your PowerPoints or anything like that.
Well, the PowerPoints are an extraction of what's in the textbook. I mean, the PowerPoints are designed by the Pearson's Canada people to essentially follow through the textbook material. So everything that's in the slides is in the textbook. Now, there are a few mistakes they made in the textbook, and I try to point that out ahead of time. Usually the mistakes are in the answers to questions, sadly, but that's the case that we're dealing with. So yes, your source document for studying is the textbook. The others are guidelines to get you into the textbook, if you will. And that's where you should be spending your time, is in the textbook, because there's stuff in the textbook that's not in the slides. They just skipped over it. They didn't mention it, but that's fair game. So again, focus on the textbook material, be it an electronic book or a hard copy book, but that's what I would recommend.
Okay, thank you.
No, you're very welcome. Hope that answers your question. And I know some of you aren't shy, and that's good to hear, actually. But don't be shy. If I'm not explaining it well enough, come back to me. Ask me to try to word it differently. Try to, if you think about it and still don't get it, send me an email. I'll see what I can do. We can chat if I can find the time or do something. But I don't want to leave you hanging if at all possible. I want to work with you. So yeah, so quiz 2, going back to that point there, is 1 week today. Quiz 3 will be a little further than 1 week away because it's going to take us a couple of weeks to get through chapter 3. It's just, I won't say necessarily longer, but it is more complex in nature as we get into the chapter. So, but for the second quiz, we'll run that 1 week today, dealing with primarily with interest types, if you will, nominal interest, sub-period interest, effective interest, continuous interest, compounding, continuous compounding, cash flow diagrams, and depreciation by either straight line method or by declining balance. That's the essence of chapter 2. And we'll deal with theory in that quiz as well, as today will be as well. It's all theory because there is no mathematics in chapter 1. The quiz itself for today will have 15 multiple choice questions. They come from a bank of questions, so not everyone will get the same questions. The questions are shuffled, so you're not going to be able to see the questions, if you will, that way. So in other words, you may get the same question, but it won't be in the same order as someone else. It'll be in a different order. So the
So
questions
are you
are
not
shuffled.
able, sorry, are you not able to go back once you complete a question? Is that what you're saying?
No. I'm misstating it if that's what you're taking from it. No. You can change your answers once you click on it. Once you save it, though, it's saved. So on each question, you'll do it. You'll check it's A, B, C, D, or E for an answer. And if you're not sure of it, you want to think about it, go on to the next question. You can come back. I do not enable, because the quizzes do have that capacity to say not to return, not to go backwards. I do not enable that. I have no problem with people. If they have a question, they're not quite sure, but they want to get on and make sure they get the bulk of the questions answered. It's 25 minutes long. That gives you over about a minute and a half per question, roughly. And it's just read the question. You should know more or less what the answer is to begin with, but you have the textbook there beside you. If you were in class, this would not be an open book exam, but I don't dwell on that. It should not be at home either, but some people will use their textbooks. So with no insult to anybody intended, I don't want to penalize someone who's applying the rules because others are not going to. I know that. They're going to use the textbook. It's sitting there. It's too enticing. So the textbook, for all practical purposes, it's an open book exam. So go ahead and use your textbook. The notes you make, things of that nature, be aware of time. Your marks should be posted immediately. And once I've cleaned up a couple of odds ends on chapter 1, I will send you an email telling you when you can view your response vis-a-vis the correct answer if you did not get it correct. And hopefully that will help you in your own mind think, understand the nature of the question and the answer in that way. I will probably set it for around the supper hour, thinking I'm not allowed to intrude on other people's time on a given day. So you may have another lecture tomorrow with someone else running from, or it might be their day for, we'll say from 8 in the morning till 4 in the afternoon. So I will probably set it for 5 or something like that for you to take a look at it at that time. So, and I'll get that out to you today as to when, but I need to clean up a couple of odds and ends in this regard yet before I can make it available in that regard. So I'm going to, at least at this moment here, I'm going to stop sharing my desktop that you're probably looking at. I'm just checking the chat line. There doesn't seem to be anything in there that we did not address. But if I missed your question, just send it to me again, please, via email, and I'll see what I can do for you. And that's pretty well it, I guess. How many people participated today? It looks like 53. Probably a few have signed off already. So I'm done. I'll hang in here until most of you are gone. And at that point, I'll just simply terminate the balance.